Good afternoon and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending November 3rd, 2023. And today I'm going to title the video, Layoffs Signal a Recession in 2024, which puts the Fed on pause. And that was really the big news. If you go back to my video last week, I said we went into support. We're entering the Fed meeting week. There's likely to be economic data that should support a Fed pause. And that's ultimately what you got. Sometimes you get it right. I think I got it right. So we're going to dig into the details and talk about what to expect next. All right. We had construction spending at the beginning of the week. That one did tick down a little bit, and I'll talk a little bit later why this is important to follow to see where construction employment goes. Okay. Initial claims for unemployment. Let me zoom in here. Obviously, there's the COVID spike. This had been really decelerating. Let's go to a one-year chart. This was rising throughout the spring and it peaked in June. And that was really started the takeoff in the 10-year rate. Oh, went all the way to 5%. And now you're starting to see this tick back up again for the second month in a row. Now, it's only 2 months, but you're above the 4-week average. And it'll be interesting to see how this goes, especially when you look at the rest of the labor picture. Something to keep an eye on. Durable goods orders, that did come out 0.44%, slight tick up from last month, still positive, so that's pretty good. Non-farm payrolls did go down to 150,000, and the big story was really the downward revisions of September and August, a total of about 101,000. So if you combine the 150 gain in October and you subtract out the 101,000 revisions downward for the previous 2 months, that was a net only 49,000 jobs. Obviously, that starts to become a more dire picture. The unemployment picture becomes more dire when you start to see sub 100,000 numbers. Okay, unemployment rate did tick up despite the labor force shrinking. So typically, labor force shrinking, all else being equal, the unemployment rate will tick down. But instead of ticking down 0.1%, which was what the labor force participation rate went down, it actually ticked up. So really, there was about a 20 basis point increase in the unemployment rate, all things being equal. And there's the adage that if you go 50 basis points above the low in unemployment, then you're entering a recession. And you could call it that, right? I think the bigger question is when. I think it's pretty clear you're going to have a recession sometime next year. Probably not first quarter, maybe second quarter. Could be pushed off to third or fourth quarter. A lot depends on what happens with interest rates, what happens with fiscal stimulus, what happens with the yield curve and Fed policy, et cetera. But this is, once again, signaling a recession in the future, okay? And then when you're talking about the average hours worked, that did tick down as well to only 4.1% year over year, not average hours worked. The year over year earnings, average hour earnings, there we go. And that was the lowest level since going back to June of 2021. So a average hourly earnings growth of about 3.5% is consistent with about a 2% inflation rate. So the question is, how far away are we really from this particular, the Fed being, hitting its target, I think is the question. This was the most interesting part of the report, though, and this was about industries. Okay, and what I'm highlighting here really is, let me see if I can zoom in a little bit. There we go. I'll zoom in for you. So what you can see is that the strength in the labor market right now is actually in government, that's the red, and in healthcare and private education. Those are not cyclical industries. So the Fed and interest rates don't really have a lot of sway over that. But what you can see is, here's the yellow, professional and business services, that is flattened out, okay? And actually, you look like you had a slight, it was still tick up, but it was very minor, month over month. Retail trade, that has been flat for a while. You're having manufacturing, that one's slowly kind of ticking down, right? So flattish to down. Another cyclical sector. Financial services, financial activities, also going sideways. Transportation and warehousing, that's where job losses are happening. Another cyclical sector. The most cyclical sector that you have to pay attention to, though, is construction. And we're still adding construction jobs. We talked about this. Lack of supply within the existing home market is driving the ability for these home builders to continue to build more. Information technology, that one is shrinking. You can see that here slowly. Another somewhat cyclical sector. So the strengths are in the sectors, strength of the job markets are in the sectors that are not cyclical. And so you can already say that the trend in aggregate of the cyclical sectors is modestly negative. And therefore, the impact of the tightening policy has pretty much fully been felt. And you have to say in the cyclical sectors, you are neutral to modestly shrinking. Now, the ISM services report kind of back that up. Here's the employment index down to 50.2, basically 5. Remember, anything above 50 is growth, below 50 is negative. You're 50.2. It's called neutral. The prices paid index, that also did go down to 58.6. I forgot to just show the ISM services PMI at 51.8. So that's almost going back to neutral as well. But prices paid, that did tick down a little bit, but not as much as you would expect considering the weakness overall in the ISM report. So a bit of kind of stagflationary type of data in the services, ISM services index. So that was the economic data that fed through to the market this week. And obviously that fed into a Fed pause. And that's what we have priced in for December. There's now a 95% chance of a pause. January as well, a 91% chance of a pause, only 8.6, or call it, if you combine these two, 8.8% chance of a rate hike between now and January. And then March is where you start to see potential for a rate cut, and actually more potential for a rate cut than a rate hike. 25.5% chance, in fact. And May is now over a 50% chance that there will be at least one rate cut between now and May. So coalescing around that second quarter rate cutting cycle commencing. And I think that's about right. I think the market's starting to call the reality of the situation. I thought the Fed rhetoric and the higher for longer rhetoric that was dominated last Fed meeting was a little bit too extreme. The economic data just was not supporting the Fed staying tight for a super long length of time. Now, going over to, let's go to the 10-year. The 10-year has pulled back pretty dramatically. Now, the Fed talked about, or many Fed members in speeches over the past couple weeks talked about the long end of the curve, this the 10-year, moving up, doing a lot of the tightening for them. And we had about 5%, and we pulled back now to 4.558 at the close on Friday. Now, that's easing, right? That's easing of financial conditions. Same with the dollar. The dollar is now at the lowest level since late September. That's an easing of financial conditions. And if you get continued downtrend there, that could, I think, stave off a recession until the back half of the year. I think if you get a resurgence of 10-year back towards 5, the dollar back towards the highs of the year, then that would mean that this reaction by the market is more of a flash in the pan, and those tight conditions are going to continue to break more things. But if now the market is starting to price in, okay, we can price out all hikes. We're only going to price in rate cuts at a certain point in 2024, then that should bring rates down, dollar down, and that should be good for risk assets. And let's talk about that. Risk assets obviously did well this week. Here's the S&P. Talked about last week. We were at support, and look what we did. We rallied on that pretty much every day this week. Now, I didn't think we'd rally this hard. I'll be frank. But, when everyone is negative, and sentiment was pretty bad last week and the previous couple weeks, and you get a pretty clear indication that the Fed is going to pause, they asked the question at the end of the press conference, something like, what are the risks of the economy? And Jerome Powell basically said the risks are becoming more balanced. Now, it seemed like he's still trying to hint that the risk of inflation was higher than the risk of an economic calamity. But pretty clear, if you're going from a hawkish situation to something that's more balanced, you are incrementally over time getting more dovish. And by this time, next Fed meeting, the last of the year in December, well, they'll probably also be dovish as well. And the economic data on Friday obviously backed that up. So that's why you got a resurgence on Friday. Small caps, those also rebounded probably stronger. Let's look at a ratio here. IWM to the SPY. Yeah, especially Friday. That was the big move. The Qs got a nice rebound as well. But did they rally as much as small caps? Small caps did have a better week. Let's look at the NYSE. Yeah, we're rallying. This is resistance. You have this breakdown area, the 50-day moving average, the 200-day moving average. I expect consolidation here. This is a pretty big move in a short period of time. But ultimately, when you have this breadth thrust, there we go, higher, that likely means that you have pivoted, right? It's a true market pivot, and sentiment's likely to go the other way, right? From overly bearish to eventually getting probably overly bullish. And we're heading into the holiday season. We're just a few weeks away from Thanksgiving and then Christmas season. And typically you get that Santa Claus rally, especially when the market is up for the year, which it is. Okay. Commodities held in there. Not an amazing week. Obviously, oil did pull back. So that kind of weighed on the indices. But gold did much better. Another consolidation week, but the real story was here, the GDX. That had been underperforming. So if you go to GDX to gold, that one is pulling back, right? This hasn't had a strong breakout, but this breakout on volume is something to watch. Now I want to see it get higher than that October high, and then I will say this is broken out. Gold is ready for that next leg higher. Something I'll be watching. Same with the silver to gold ratio. This has not got its sea legs back into an uptrend. This has been more of a pullback consolidation. So I want to see those two things kind of line up to give me confidence that precious metal move is on in earnest. Okay, so I do think we're getting close to there. And we talked about duration risk, and you're starting to see the duration parts of the market rally, and that kind of was a tell, right? Look at IYR, real estate getting a nice move above the October highs, so that is positive, above the 50-day moving average. That is positive. The utilities, the duration type trade above the October highs and the 50-day moving average. So all of this bodes well for the duration trade. Now, ultimately, I do think we probably make a higher high sometime next year on the 10-year, and you're going to get another sell-off in duration next year. Mainly because I think the Fed is going to be careful to not get too dovish, overly dovish to inflame inflation. And you also have a lot of issuance. The Fed plan for refunding for Q4 and Q1 of next year was mainly closer on the short end than as opposed to the long end, and that should help keep those longer rates capped. But there's still, I think that was more a reaction than understanding, hey, there's still a lot. Yes, they're doing less than they were before, but it's still a lot, right? And there needs to be balance sheet for that. And when you're doing QT, you're pulling dollars out of the system. And so ultimately, I do think you get one more push higher next year in rates before you get kind of a more clear downtrend in rates for the near term. Now, long term, I think still rates are higher, but as you go into maybe the back half of next year, I think that's when you'll get the more earnest pullback in the rates market. Let's take a look at the credit markets. This is another sign that, hey, we're probably going to get a risk on rally continuing. Look at this move. This is the short-term junk to short-term treasuries, and the short-term junk market rallied extensively. Look at this. Basically pricing out a credit event. And the move index, not the Q move index, just the move index. There we go. That has pulled back significantly as well, not breaking out into the 150 level. So that's also a positive. This is interesting too. Growth of value. And this is starting to get some major weakness. Testing that 100-day moving average again. It already did it once. When it does it again, it's going to be less support. And I think you're getting that rotation out of growth and into value. And a lot of that is the dollar, weakening dollar. So I think this rally into year end is going to be in those more value type sectors. There's VTV. Here's the XLF, right? Getting a nice rally. KVE. That's what's really weighed, I think, on the value sector so far this year is just the financials. The financials dealing with the banking crisis in the beginning of the year and just higher rates weighing on those balance sheets. And so if you get that kind of abating near term, I could easily see value start to outperform once again. Energy, definitely not the strongest week of the year, but Thursday was a nice positive move. And if the dollar continues to weaken, I think energy is poised to move to new highs by year end. Let's see if there's anything else I want to get to. Let's look at the VIX. Lastly, the VIX has pulled back, and once again, that's a risk-on event. So ultimately, this is why I say layoffs signal a recession. They do in 2024, which is putting the Fed on pause. But that does not mean that you can't get a rally into next year. And even to start the year, I think that's very possible. Because I don't think that you're going to get a major recession. I think it's going to be very minor. And it could easily, based on the fiscal stimulus, be pushed out. And I think the big question will be is how long can corporations stave off refinancing? Because they've been trying to do that, right? But eventually they have to refinance. That increases their borrowing costs. That increases their overhead. And to maintain profitability, they typically have to lay off people. And that starts to snowball on itself. So far, because a lot of corporations have termed out their debt, meaning, hey, when rates were at 1, 2, 3%, they were issuing debt at 4 and going out to 2040, right? And that's fixed. They don't have to worry about it, especially those large corporations. But not everyone did. And eventually there has to be that refinancing, which causes that, I think, that negative feedback loop. But so far, it hasn't been widespread, hasn't been major, and the increase in income coming from money market accounts and treasury bills that people are buying, that has kind of offset all of that. So that's kind of where we're at. Once again, bullish into year end, but ultimately a recession in 2024 is likely. But you don't want to jump the gun. And frankly, don't think you're getting a 50% drop in the market just because of recession. I really don't think that's happening. This is not a financial crisis. This is not '08. Do you get do we power to new highs by, maybe a middle end of the first quarter, and then you roll over and then the lows are somewhere around, what we just saw. I think that's certainly possible as well, right? Go through a long multi-year kind of choppy period. That's kind of what we've been in, right? If you look at let's go zoom out to the monthly on the NYSE. Like we're at the same levels we were in the beginning of 2021. roughly. So we're just going through a consolidation period for 2 years almost now. Could that drag on to a third year? Certainly possible. Very possible that we could just be going through a choppy consolidation period that frustrates people, frustrates the bulls and the bears, right? Because the bears, you don't get a major sell off. The bulls, you don't get major breakouts. You get vacillating both ways. And I think that's the most likely scenario, at least in the medium term. So, you have the different outlooks. I think short term, bullish, medium term, neutral. All right. I want to thank you all for tuning in. I appreciate you all liking and subscribing to this channel, as well as our podcast, InvestTalk. A reminder, the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own. They do not represent those of KPP Financial or those associated. Have a wonderful weekend.